My role here is to, again, tie the papers together in some way and kind of make sense out of this. And I'm also going to challenge each of the presenters with maybe a little more academic type questions. But I don't want to take too much time because I want to turn it over to the audience, and I'm sure that the presenters would love to hear from you. If you were to design, if you think about incentives, and incentives are important, right, when you create these types of programs. And if you were to think about how can we assist firms who don't have a lot of paperwork, and don't a lot of track record behind their history, maybe they're relatively new startups, how can we best assist them? Well, you put a bunch of economists in the room, and well, not too many because they won't agree on anything. You put a couple of economists in the room, and they're going to say, well, what we need is some sort of a credit guarantee program to overcome this, right? So, but we don't want to guarantee all of it, because if we guarantee all of it, we create what we call moral hazard, which means that banks can, and we would never see this, right, in the mortgage market, banks can simply make mortgages and not care about the quality and then sell them off. Right? Now, we know that community banks did not do this, but certainly there was enough participation by many of these Wall Street banks that did do this. And so you have to control for that. Well, so how about we share the risk, right? 85% of it, up to that, can be covered. Also, what if the government entity, the Small Business Administration, would have authority to actually oversee and regulate the lending? And does that make sense? Does that allow us to better control the loan quality that we're going to get? And so the SBA program does all those things. It is a mixture of carrots and sticks. And banks, although not a lot of banks actually formally participate in the Small Business Administration program in many states, there are reasons that they might want to join, right? You can create relationships with firms. These firms can grow over time. You can develop a nice lending relationship, a long-term relationship. You get to keep interest income. You get to keep fee income. If you sell the loan, the SBA has indeed made it easier to sell these types of loans in the market. And there's sticks, right? So it's not just free. It's partial guarantee, not a full guarantee. The SBA does then have some authority to oversee and kind of give you a rating or monitor your activities as far as how these SBA loans are performing. And of course, paperwork, right? So, which is probably the most important reason that more banks don't participate in the SBA loans, because you have to follow an additional set of guidelines, and the paperwork probably grows a half inch or so when you have to adhere to these regulations. So there's costs, there's benefits, it works well. CRA. This is a piece of legislation with a long history now, and clearly a noble goal. Right? The goal is to reduce discriminatory behavior by creditors, and the goal is to allow more access to credit to low and moderate income borrowers. Okay? And so I think we would all agree that it is well intentioned. You put a group of economists in the room and you say, how are you going to design a program where banks can minimize discriminatory behavior, if it exists, or they can increase credit to relatively low-income households, and not make the program so onerous, right, that it's all sticks and no carrots. That is a tough order, right? That is a tough thing to do. And I think that the CRA is messy because it is a social objective, social policy that banks are implementing, right? And the guidelines for exactly how to do that are quite broad. And so we get into a lot of things that are difficult to measure. We get into things like quality. We get into things like disclosure. And those are things that researchers are not comfortable with because we like hard numbers, right? So there was the really nice paper last session that looked at the $10 billion threshold of whether if you're lower than that, above that, what are the additional costs and incentives? Well, that's a hard number we can anchor around. But you talk about disclosure policies and you talk about quality, and there's not a lot that I think academic researchers could draw on, not a lot of research they could draw on to come up with a consensus for how to go about this policy. And so we kind of muddle through, right? And we update, we change the CRA occasionally as needed, and it's always a very difficult and political conversation, so it's hard to make changes as well to this program. Now, having said all that, all these authors, these three authors really need to be complimented for their hard work, and they have tackled issues that are done in a very different and insightful way than we've seen in the past. And two of them have dealt with disclosure and then quality. Very difficult things to discuss. And so that's, I think, why, another reason why these papers are so informative and really new in the literature. Now, having said that, let me, if I could, just ask a couple questions, and I'll go through and I'll ask one question of each of the authors, and some of the, maybe the more detailed issues in the paper, more academic side. John, we'll start with you, just because you were the first presenter. Your evidence is circumstantial, right? In the sense that you're saying, well, if there's a lot of branches in a market that also have small business lending authority, then we're going to look to see what happens in that county, in that market, right? So it relies on circumstantial evidence. One of the things that I noticed in your baseline coefficients and on many of the results is that the coefficient on that SBA branch share is either zero or insignificant or negative. Not the interaction, right? But the baseline coefficient. And it seems to suggest that the more SBA lenders you have with the way you've measured it, which is creative, right? Good way. The more lenders you have in that market, all else equal, in non-crisis times especially, you actually get less SBA lending. So I wonder if you could explain that.
Yeah, and this is a great question, and Alan will applaud you for asking this question too, because it's a comment he's made to me in the past as well. I focus on the crisis just because there was such a focus in general on the crisis and small business lending. So the dependent variable is not small business lending by the SBA, it's the CRA. It's using the CRA data. And so I do a separate analysis where I look at the SBA portion of that as best as I can match it up and the non-SBA, and it seems to be coming from the non-SBA. As far as kind of that baseline coefficient, which would say that overall, you have more SBA lenders, you're going to have less total small business lending in that area. That's not something that I've discussed a lot in the paper, and I think that's kind of the next iteration and going deeper. So maybe the SBA lenders really help in these times where small businesses where they're really constrained, where they need the funds, but otherwise, maybe some bank moral hazard comes into play. So critics of the program they'll often say, you get this credit guarantee, and banks are going to take more risk. It's similar to some of the other papers that we've seen, and certainly that could be going on as well. But I think you're right. That's something that I need to dive a little deeper into in the next iteration.
Okay, thank you. Yue, I noticed that the main risk measure in your paper was non-performing loans. But to me, if you're going to address or really assess the cost of disclosure, then a better measure, maybe more direct, is simply looking at charge-offs. And have you tried to look at the charge-off rate?
We haven't. We choose the non-performing loan because relative to charge-off, we think non-performing loan is more timely measure of loan default. But we do try an alternative measure, which is the loan loss provisions. And the results could go through, but unfortunately for loan loss provisions, the core report do not break out this by loan type, so commercial versus non-commercial loan. So we decided to use this non-performing loan as our primary measure.
Okay.
Yeah, but we could try the charge-offs.
Yeah, I would suggest that. If a bank has to deal with more delinquent loans, but yet in the end, they're collected, then it seems to me the social cost is less, right? But if there's more charge-offs, then that's a real cost to the bank. And it would, I think, make your argument stronger. And then finally, Taylor, I think for me, the first of all, very impressive paper, and I think that you really did a whole lot of robustness and so on that really answered a lot of the questions that people had, probably even going through this presentation. Well, what about that? Oh, okay, you talked about that. Well, what about this, right? You talked about this. But one thing that I think the paper could benefit from is providing more information on the types of complaints that are in there. And so you give one example, which is excellent. But I know there's 187,000, but boy, I need to know how many of those are just very small, irrelevant almost complaints, right? And how many of those are more serious that really have substance to it? And I think that would enhance the paper a bit as well. Also, it would be nice to see more on in your conclusion on the policy implications that you have for this. Is there a way that we could design or change the CRA to address quality concerns? And that's a tough question, right? So let me just ask you. You can answer either or both of those if you've looked at in more detail the types of complaints, or if you have a great solution to solve this problem.
Okay, I'll take them in turn. So the first question about the type of complaints, the one that I highlighted up on the screen, since 2014, I believe they provide the full narrative if the consumer chooses to give the full narrative. The downside of that is they redact the last 2 digits of the zip code. So from an econometric perspective and being able to zoom in on these local areas, it kind of handcuffs us as far as that goes. Now, we've been reaching out to the folks at the CFPB and say, can you give us the full data, including that? And if they could do that, we have done some sort of preliminary text analysis to try to get at whether it is just more of a miscommunication or whether someone has really been misled in a more egregious way. So that certainly would be nice, but kind of pulling back from that a little bit, we know that there are going to be some level of sort of frivolous complaints. But one thing that we are doing is, since we're looking on a relative basis, we assume that there's going to be sort of frivolous complaints in this zip code as well as that zip code, and we're just trying to compare and see if there are systematic differences in these over and above that. But certainly, the more meat that we can add to that would help us understand, what are the implications of this quality dilution. As far as policy implications, you'll have to talk to my bosses. That's above my pay grade, and so if they want to pay me more, maybe we can get there. But it is a tough one, mainly because quality is so very difficult to measure. You could think about maybe ex post surveys, things like this, but it's always going to be subjective. So in a sense, and we're all going to have our own measure of what we think quality looks like. So I don't want to say it's an impossible task, but when you have to write rules and regulations that can be defended in court, if you will, I think this is an area that we just have to be aware that there could potentially be perverse effects. But how do we legislate this away or write rules? My hands are up for that one.
Thank you.